Futures pricing in an 89% chance of a 25 basis point hike this month after the June jobs report showed non-farm payrolls growth below forecasts. Joining us now here at Post 9 is JPMorgan Asset Management Chief Global Strategist David Kelly. David, thank you for being here. So you had payrolls coming in, about 257,000 higher in June, unemployment rate going to 3.6%.
Yeah.
What's your take on what happened last month and why the softer read isn't really doing much to stem the market's expectation for a hike this month?
Well, I think the first thing is that a lot of people overreacted to ADP yesterday because ADP is so flaky a number. I mean, private payrolls within this report grew by 149,000. ADP said 497,000, so they missed it by a factor of 3. So I think people overreact to that. No, what we're seeing is a welcome moderation. Everything we're seeing says the labor market is slowing down, but it's just slowing down slowly. And I think what we're really learning is what does 10 million job openings really mean for the pace, for the relationship between growth and jobs. And it's just keeping job growth strong, even though, there are parts of the economy that are clearly slowing.
Is it slowing enough, though? I mean, it's slowing slowly, but what does that mean, for the Fed's calculus?
Well, I wish the Federal Reserve would not worry about this so much. Next week, we're going to get a CPI report, which I believe is going to show year-over-year CPI at 3.2%. Okay? A third of what it was a year earlier. So there's no question that the economy is slowing down, that inflation is slowing down. So all we're arguing about is the pace of it slowing down. And I don't think it's worth causing a recession for a second derivative. And that's what that's why I think the Federal Reserve is just overreacting to this, because the way that they're tightening, it just raises all sorts of risks down the road, which I think they should try and avoid.
Doesn't that support, though, the stance in general of Powell of let's go slower and just take in more data between our decisions to hike?
Yeah, but it doesn't support the idea of overshooting in rates and then cutting them in 24 and cutting them in 25. Right. You should go slowly, get back up to where you think the number should be in the long run. But in the long run, they think the federal funds rate should be 2.5%. Now, I don't even agree with that. I think that might be too low. But they should just gradually ease up to that and stop. This is just being way too clever to try and overshoot and bring it down, because we don't know what the economy in the long run is going to do with 5.5% federal funds rate. And it could cause a lot of problems that we haven't really thought about right now.
The hawks, like Waller, look at the bank situation in March and argue it was about a handful of mismanaged operations. Are they Pollyanna?
Well, we know that, look, there's a problem on the asset side and the liability side of the balance sheet. Now, the liability side is going to get worse. Every month that we've got short-term rates over 5%, there's going to be money seeping out of the banking system on the liability side. But the asset side, the problem with commercial real estate, it's going to take time. This is a slow-burning fuse. And, it's kind of like when somebody's twisting a screwdriver and eventually you twist and you hear the wood break. What's the point? If we're going to get there anyway, by the end of next year, we're going to be below 2% on inflation. And if we can get there without a recession, why not do it?
Speaking of that asset side of the balance sheet, I'm just curious your thoughts on global yields right now. Global yields, 15-year high. The 2-year, I think, is a 16-year high. Investors have been really buying bonds on a bet that growth would slow, but obviously that hasn't materialized yet. So what do today's numbers mean, do you think, in terms of a further capitulation on that front?
Well, I think this is a good time to buy bonds. This is your one opportunity here. Because, the bonds are kind of like the cicada bug. They show up every 17 years. And so this is the year you can actually get a decent deal on a bond portfolio. So this is the first time you won't hear me often say I'd be overweight bonds, but I would certainly be level weight bonds right now, because I strongly believe that this is not an inflationary economy. And we're just being on this inflation roller coaster. But the thing about a roller coaster is you get off where you got on. We got on at 2%. We're going to get off at 2% again. And I think that's, we can talk about the Fed all we like, but in the end, the inflation rate is coming down.
But at one point, and Mike was talking about this a little earlier, at what point do you think the yields kind of get to that level where equity investors start to get a little more skittish? We've been seeing them kind of sell off in tandem, but at what point is there more of a rotation between the two?
I think we're very far away from that. I think the people who are pouring money into the equity market are not looking for 4% gains. Even if you get 4% of the 10-year, I think they're a different crew. So I think if people get scared about the real economy, that could hurt the equity market. Yeah. If people get scared about it's a real problem with banks, that could be a problem. But otherwise, I think people are going to reckon that eventually rates are going to be lower because inflation is going to come down. So why not take advantage of stocks that are going to do well in a low rate environment.